So, news from Bonkers Economics this week is that the FTSE 100 index has finally broken through the 10,000 mark. And everybody's excited about that. The government is saying how wonderful it is. The newspapers are reporting it as a big breakthrough, etc., etc. But what does that really mean? What does that mean for you and me? What does that mean for the ordinary person who just wants to get on with their life? Well, the first thing to say is that those companies, 3/4 of what they do is abroad. So 3/4 of that activity is abroad. It's got very little to do with the UK economy at all. And then the second thing is that 2/3 or nearly 2/3 of the shares represented there are owned by foreigners. So any profits they're making, any money that's being created or at least being extracted, any extraction that's taking place by virtue of this increase in share values, that is going mostly to foreign shareholders and not into the UK economy at all. So this is really not about us. This is not about the UK economy doing well. This is about a small bunch of very big companies, multinationals, which happen to be listed in London, and foreign owners are doing very well out of them. And a key thing to remember about share prices is that higher is not necessarily better. It's a bit like house prices. High house prices, they really help people who have invested in housing as an investment rather than somewhere to live, but it doesn't help everybody else. And shares are a little bit the same. If you've got them, then maybe it's great that their value goes up, or the price at least of them goes up. But if you're buying shares into a pension fund, for example, then you don't want them to be too expensive. You want to get a good return on them. In other words, you want the price of the share to be low relative to the amount of money the company generates. So it's fairly obvious, for example, that if a company is, say, the share value of £1 and they're creating a profit of 10 pence, then you've got a 10% return. But if that company's share is worth £2 and it's creating a profit of 10 pence, then it's only a 5% return. So clearly, the higher price isn't benefiting the return that you can make. And that's particularly true over a longer period. You want companies that are investing over a longer period to produce good, solid returns over that time. So it's important to see that high share prices aren't necessarily good in that sense. They're good for people who are speculating, but not good necessarily for ordinary people. And that takes us to this image here, because what is going on? Well, this, of course, is an image we've seen before. This is actually about currency trading in London. And this is the amount of currency trading we actually need, that little tiny little bit there, the head of the snail, as we say. And all of this is currency trading that's going on for the benefit of nobody other than the currency traders themselves and, of course, their investor clients. So this is all extraction of wealth from the economy. And this is the activity that's actually useful and necessary. And the stock market is a bit like that. A lot of it is simply about speculation. And we're pushing prices higher and higher in order to create capital gains for people who've got the wealth to invest. But that capital gain is entirely speculative. It's not necessarily real. It's like so many things. The market price gets pushed up and up and up, just like house prices get pushed up and up and up, or the price of Bitcoin goes up and up and up, because everybody is sort of playing roulette with this and hoping for the best and trying to make a gain, a capital gain, by inflating values. But inflated values are not real values. And at some point, the whole thing is going to come tumbling down like a house of cards. And who's going to pay for that? Well, naturally, as we know from 2008, the least well off will suffer the most.